tackle the markets, or do you reckon that a lot of pain could be in the price?
Yeah, I think it's a very difficult question to answer. I think there are too many uncertainties which are there in the globe, and it is currently reflected in the kind of relentless selling which is happening not only in emerging markets, but also if you look at the US market itself, I think there is a huge amount of redemptions which are happening over there also from the equity markets. But coming to India specifically, my sense is that two, three things which are very important to note. One is that if you look at the way the relentless selling, the US, I mean, we have seen the FPI redemptions. The resilience of Indian market is to that extent that see the kind of inflows that the retail investors have been putting in into the domestic mutual funds and direct investing. So as we speak, possibly direct retail now owns more than almost 10% of the Indian capital market. Mutual funds own around 7-8%. So now collectively, retail India is owning 17-18% of the market versus the FPIs which are owning around 20%. So one thing is very important to notice that domestic investors have become much more mature to understand that sometimes this FPI selling is for various reasons which may not be only connected to the local market environment or local economy. It could be for various reasons, and they have understood the value, the benefit of investing in equities regularly. I think this is a very important thing that one should note. Otherwise, imagine with this kind of selling, where our markets would have been. We have seen earlier in 2008, etc., when there was this kind of FPI selling, our markets would have also cracked by, say, maybe 40, 50, 60%. But that has not been the case. Look at our currency. Our currency is holding out very well. We are just some 5% down versus on a one-year basis versus the USD. Versus look at the other currencies, how they have behaved versus the USD. So I think our markets are in a very strong situation relative to what it could have been. Now, having said that, yes, there has been a sharp correction from 18,400, 500. Last 7 months now, we are basically kind of in negative territory or nothing has happened. And one-year returns are now less than 10%. So the question, the dilemma investors can have today is that should I respect liquidity, which is this SPI selling, etc., or should I respect valuations? I have a feeling now that the time has come that one should ignore liquidity, which means, and look at valuations and invest knowing fully well that we don't know when the tide is going to turn. So valuations have become attractive in some segments of the market, and these are some segments which are basically over-owned, or they are where FPI is heavily over ownership. And now this whole active versus passive and this ETF-based selling, everything gets sold. It's right valuation to the wrong valuation, but everything gets sold. Similarly, when there's buying, then expensive become more expensive, and in selling, this what is value become more value. But my assessment is that I would be looking to selectively now start investing into the market, knowing fully well that I don't know when this FPI selling will end. Domestic fundamentals are reasonable. Yes, there are tangible inflation, interest rates, margin pressure, etc. But some of it is in the price, and maybe in the next quarters, it will get further reflected. So I think you have to be selectively looking to invest and looking to average on the downside.
You mentioned an interesting thing. You mentioned
Sorry,
margin.
I couldn't hear you.
Yeah, no, I was saying you mentioned an interesting thing about margin pressures. Have we seen that in the recent past, in the last, whatever, a month or so?
So if you look at margin pressure in the sense the corporate India, yes, they have seen pressure. That's what I was referring to. As far as the other margins which you're talking about, retail investors seeing any margin pressure, I think the rules keep on changing, and as per the rules, there have been some tinkering and there have been some changes, which has put some pressure on retail investors.
Okay, sorry, I got confused. I thought you were referring to the investor margin pressure and not the corporate margin pressure. Okay, there's a train of thought which says, and I don't know how right or wrong, but that the big macro trade currently might be to buy bonds with the yields at circa 8% or thereabouts, presuming the yields do reach there at some point of time. And if that were to happen, that's an indication that it might impact economic growth simply because at those high yields and those high interest rates, the economy can't grow very smoothly. Now, the question is, if that were to be a hypothesis that plays out, it should be net negative for equities, right? I mean, lower economic growth is not something that the equity markets would like. I mean, that's probably one piece of good news that the markets anyways want, which is economy growing well. And if that doesn't happen, could that impact markets?
See, as far as looking to invest in bonds versus equity, I think it is a part of individual asset allocation and risk appetite. So that is one thing which every investor or every keep on continuously reviewing in terms of where to put money and on an overall basis. But having said that, yes, I think rising interest rate environment does impact the valuations of the equities. And to that extent, yes, it's negative for the equity markets per se in terms of A, valuation, and B, what you said is right, that there could be some outflows from equity into the bond market. That could be there, but I think you should look at the real rate of interest. If inflation also is so high, then would I be good enough to invest into bonds per se? Yes, I mean, if you're putting money into a 10-year bond at around 7.5% kind of 10-year yield, I'm sure you are expecting that over a 10-year period, inflation may possibly be not there. So I think these opportunities, people will keep on balancing their portfolio, which will happen. But I think you should look at the opportunities which India offers in terms of all the positives which we suddenly, when the markets correct, we all forget about. Right from our domestic consumption to China plus one, and all the various reforms, etc., the government have unleashed. I think all these will keep on giving the benefits over a period of time. I think the problem today is that we are so, human nature is to just extrapolate the current into the future. So maybe 1 year ago when the markets were booming, we had factored in that the markets will always keep on booming 2-3 years down the line. And today, because of various reasons, there are redemptions, etc., there are some challenges. Markets are correcting, and we are not willing to look at what positives can come out once things settle down. I mean, whether it will settle down in 6 months or 12 months on a global basis, I don't have an answer to that. But we have seen this keep on playing out. Remember March 20 to May 2020, when COVID was just opening up, and I mean the lockdowns were just starting, and COVID, and the way we sold off, and after that we saw history, how things came out. So similarly, I'm sure solutions will be found for high interest rates. But having said that, I think there is one thing which we have to understand is that there is a definite reset which is happening. We enjoyed high liquidity, low inflation, etc., for the last 8-10 years. Probably that is not. It's not going to be the same amount of liquidity and low interest rates going forward. So to that extent, the valuation that you will be giving to stocks, you should look to that. You should not just extrapolate whatever valuations we were giving to various companies, businesses in the immediate past to expect to get similar valuations at least for the next few years. So my biggest fear today is not on the earnings growth or me getting earnings right for most of the companies that we own. My biggest fear is that will I understand the valuation multiple? Will I be able to get a hang on what the market is going to give as far as valuations for various companies? That is more of a risk.
So can I ask you that if that is the construct which you are contemplating or exploring the markets with, safe to assume that you might prefer the value end of the market a lot more than the growth end of the market, or would you value that part of the market more, which is priced well as opposed to priced egregiously, even if it shows very strong growth?
So I think my sense is that the risk of going wrong is very high in overvalued companies, which I would put it this way, that you should look at how similar stocks were valued, say, 10 years ago. I think maybe the consumer companies were valued at, say, around 25, 30 times earnings. Now they have reached some 60, 70, whatever, 50 times earnings. So there the risk is that, okay, will the market sustain these valuations? I think the risk is more on overvalued companies versus a historical perspective. Now, if the company is today what we are buying into is value maybe 10 times, 12 times earnings, or maybe one time price to book, etc., you could go wrong as far as whether the market may recognize them, may not recognize them. But in terms of multiple derating, I think a multiple derating is a far bigger risk to portfolios than earning. Earning obviously is there. So I would tend to look to invest in companies generally which are relatively under-owned and obviously give reasonable valuations with decent growth prospects. So I'm not in the camp to buy growth at any price or that kind of a thought process.
Got it. Okay. Can I probe that point a little? Because I was just noting down, that's actually the headline for this conversation for me, that the risk of going wrong is very high in overvalued growth stories. Let me try and probe this a little. Let's say information technology, wherein companies and the broader end of the spectrum are saying that they will continue to grow 15, 20% for a better part of the next 5-6 years. A year or two could be here and there, but largely their growth seems intact. The valuations are not cheap. They've corrected quite strongly from the highs, but you could argue that some of these are not cheap. And there could be other sectors like that too. But I'm using this as an example. How do you approach this then?
Good question. I think so. There are two parts to it. One, obviously, there has been a sharp 20-25% kind of correction in many of these companies in the last, say, 30-40 days. So there is a possibility of, can there be a technical bounce up? Yes, there could be a possibility of a technical bounce. But having said that, I think on a valuations perspective, from a historical averages, the way these companies have been valued, they are quoting at a reasonably high premium to historical averages. And at one level, most of our IT companies are US facing. 70-80% of their businesses come from US facing. Currently, when we talk to most of the companies, all the businesses, order flows, etc., everything seems to be strong. But at one level, we are so fearful of a soft landing or a recession in the US 12 months, 18 months, 24 months down the line. And what makes us think that the same order book, which is so strong today, a few orders can always get cancelled. And when these things, and when you have earnings cut, and then there will be a multiple derating also. So I would be very, very careful and wary of investing in IT companies today. A, because of the high valuations, and B, because I don't know how the US economy is expected to fare in the wake of rising interest rates and the need to have a soft landing or a recession, how it is going to finally pan out. But that is the risk. So IT companies, I mean, that's the question that is there in my mind, that are we going to get into a trap? Plus, no pricing power. Look at the margin guidance most of these companies are talking about. They all guided on the lower margins.
Yeah.
So where is everything else is right, going right for the companies. But my fear is on the order book itself. What prevents US companies to say, okay, my business is under pressure, etc., etc. I want to just shift my IT programs maybe by 2-3 quarters or 1 year. Then what happens?
Yeah, interesting one. The other one that is, and I'll take maybe 3-4 minutes more of your time. The other one that is starting, and then my final question would be, what is it that you like in such a scenario? But before that, a space that is kind of confusing me is metals. There is a bit of a correction in the whole of last week in the commodity prices. They're still at a higher normal than what they used to be. all arguments, the earnings could still look okay. But the sentiment around metal prices is iffy. I mean, if China opens up, if the war diminishes and Ukraine starts rebuilding, all of that factors could be positive. But they've gone up so much that they could be coming off to how do you think the market reacts to such a scenario over the next 3 quarters?
So I think my sense is that as far as metals are concerned, I think we are in a big big global positive cycle in the stocks.
Okay.
And what we are seeing is that within a cycle there is a correction which we are going through. And most of the domestic metal companies, their balance sheets are as robust as they could have ever been. So they will settle at a higher valuations. And traditionally, the last 10 years, we have seen that if you have ignored metals in your or commodities in your portfolio, it hasn't mattered because there were other sectors which did very well. But going forward, I believe that we should not be so anti-commodities in our portfolio. I think a 10% exposure. So I would not even say metal, but even other commodities, be it fossil fuel, be it refining companies, etc. I think you should have an exposure to that because there's a lot of value over there. And I think in an environment which is now becoming more and more protectionist, you could possibly see that domestic metal companies will continue to do well, even if there are global challenges.
Interesting. Does that include cement? I had to ask that question simply because of the large M&A transaction done.
See, I think cement is a very local local commodity, and there are too many logistics and those kind of opportunities which take care of. I mean, so it's. I think we are as far as because of the infrastructure, etc. Cement companies will continue to do well. I think currently what they are going through is a lot of input cost pressures, and but we continue to be positive on a few of the cement companies where we believe that valuations have corrected reasonably in the last 6-8 months, and the prospects are good from a medium-term perspective. And also, I think this transaction, whatever has happened, I think it's a milestone event in the corporate India history that a domestic entrepreneur, 70,000-80,000 crores kind of a transaction, and you buy out a global MNC. I think it just shows the positive aspiration or positive that you expect in going forward in terms of the opportunities for any entrepreneur to put in this kind of a bet in a sector where you are new to the sector. So it's a very, very positive way to look at it.
Okay. We have standard disclaimer.
Standard disclaimer, yeah. Please.
No, standard disclaimer at our end as well. That the Adani Group is in the process of acquiring 49% stake in Quintillion Media, which is the promoter and the owner of the platform that you are watching currently. So okay. Standard disclaimer at both the ends, if you will. And I don't think Krishna's answer anyways meant that you go out and buy ACC Ambuja in any fashion whatsoever. Just from an industry perspective, I think he's saying that it's a landmark event. My final question, Krishna, what is it that you therefore believe you would be wanting to make principal parts of your portfolio? What themes then stand out within all the constructs that you laid out?
See, my sense is that this is the time to have more of a balanced portfolio. But having said that, where are the corrections or where are the opportunities? I think there has been very good performance by banks and financial services, whether it's some of the NBFCs and some of the banks, and they have corrected also, or some of them are quoting at what they were quoting, say, in September. And constantly, quarter on quarter, numbers are very, very positive. Problem is that's an overowned sector, but despite having being in the overowned sector, I would still say that if you have the space to buy more, you should look to buy into the banks. Another segment which we are very bullish on is the whole capital goods sector across the chain, depending on my judgment is that capex cycle, if you speak to corporates, etc., nobody is going to change their growth plan just because the markets have corrected by 10% or whatever. Balance sheets are very robust and they see a lot of opportunities because of China plus one exports, domestic manufacturing, etc. So my capital goods segment is one segment which should deliver very good returns. And the third where we are very bullish on is the whole automobile sector. I think that business has not delivered to its potential now for almost 5-6 years.
Yeah.
They are consumers of metals. Demand is robust in some of the passenger vehicle segment, in two-wheelers and commercial vehicles. So selectively, we are very, very positive on the automobile, some of the automobile companies. So that's one where you put incremental money to play. IT would be very, very opportunistic and more from a trade perspective, but otherwise I'll be very, very wary of investing in IT.
Yeah, and we've seen two large announcements for capex from the auto majors as well, both Maruti and Tamo. So in that sense, it's pretty interesting too. But this was lovely. Thank you for laying it out, the construct in much simpler terms. I'm sure this is very useful for everybody who's listening this, certainly for me. So thank you so much for that. And thanks so much for talking to us today.
Thank you very much. Thank you.